Every April, something happens in this country that nobody questions. Tens of millions of Americans sit down with a stack of forms, or a laptop and a piece of software, and calculate exactly how much of what they earned last year now belongs to the federal government. It feels ancient. It feels like it's always been there, like paying rent or obeying a red light, one of those permanent fixtures of American life that must trace back to the founding itself. Most people assume the income tax has simply always existed in some form, a quiet, boring, structural fact of the Republic. It hasn't, not even close. For the first 125 years of this country's existence, there was no federal income tax at all, and for most of the brief periods when there was, it touched almost nobody. The version we live under now, the one that reaches into the paycheck of nearly every working American before that paycheck ever lands in a bank account, is barely older than the automobile. It was born twice, killed once by the Supreme Court, revived through what its own architects privately believed was a doomed political trap, sold to the public in its modern form by a cartoon duck, and quietly wired into the American economy through a wartime accounting trick that most of the people it affected never fully understood. None of that is the story most people carry around in their heads. So let's build the real one, piece by piece, starting not in 1913, where most retellings begin, but half a century earlier, in the middle of a war that nearly tore the country in two. In August of 1861, with the Civil War 4 months old and the federal treasury already buckling under the weight of raising and equipping an army, Abraham Lincoln signed the Revenue Act of 1861. Buried inside a bill mostly concerned with tariffs sat something genuinely new, a 3% tax on annual incomes over $800, the first federal income tax in American history. It was never really collected in its original form. Congress rewrote it almost immediately, and the version that actually went into effect, the Revenue Act of 1862, taxed incomes between $600 and $10,000 at 3% and anything above that at 5%, alongside a new office called the Commissioner of Internal Revenue, the direct ancestor of today's IRS. 2 years later, with the war dragging on and the debt climbing past $1 billion, Congress pushed the rates higher still. This was never framed as a permanent feature of American government. It was framed exactly as what it was, an emergency measure to fund a war that was bleeding the Union dry. And once the emergency ended, so did the tax. Congress let it expire in stages through the early 1870s, and by 1872, the federal income tax was gone entirely. For the next 2 decades, the federal government funded itself almost exclusively through tariffs on imported goods and excise taxes on things like liquor and tobacco, a system that, by design, fell hardest on ordinary consumers rather than on wealth or income. If you drank, smoked, or bought anything manufactured overseas, you paid the federal government's bills. If you owned vast tracts of land or sat on a fortune in railroad stock, you largely didn't. That imbalance didn't sit well with everyone, and by the 1890s, it had become one of the defining grievances of American politics. Farmers crushed by falling crop prices and mounting debt, organized into the populist movement, saw a tax system that squeezed them at the store while leaving the era's new industrial and financial fortunes almost untouched. 3-time presidential candidate William Jennings Bryan built entire campaigns around the idea that the wealthy needed to shoulder more of the federal burden. In 1894, that pressure finally produced results when Congress attached a 2% tax on incomes over $4,000, then a very comfortable sum, to a broader tariff reduction bill. It lasted about a year. A stockholder named Charles Pollock sued to block his own company, the Farmers Loan and Trust Company, from paying the new tax, and the case reached the Supreme Court with startling speed. In April of 1895, in a 5-4 decision that remains one of the most consequential rulings in American economic history, the court struck the tax down. The reasoning was technical, but the effect was total. The justices ruled that a tax on income derived from property, meaning rents, interest, and dividends, was a direct tax under the Constitution, and direct taxes were required to be apportioned among the states according to population, an almost impossible standard for an income tax to meet. The ruling didn't just strike down one law. It effectively closed the door on any future federal income tax, constitutional or not, for as long as the Pollock precedent stood. Farm organizations denounced it as proof that government and big business were working hand in glove against ordinary Americans, and for over a decade, that door stayed shut. Here's the part of the story that almost never makes it into the popular version, and it's the part that should genuinely surprise you. The income tax didn't return to American life because reformers finally won a great moral argument. It returned because a group of conservative senators, trying to permanently kill the idea, badly miscalculated. By 1909, pressure for an income tax had built up again inside the Republican Party itself, driven by progressive Republicans and Democrats who kept trying to attach income tax provisions to tariff bills, the same maneuver that had triggered the Pollock case 15 years earlier. Senate conservatives, led by Rhode Island's Nelson Aldrich, needed a way to make the idea disappear for good without the political cost of simply voting it down outright. Their solution was almost elegant in its cynicism. Rather than blocking an income tax law that the Supreme Court could strike down yet again, why not propose a constitutional amendment instead, one explicitly authorizing an income tax without apportionment? Amending the Constitution requires ratification by 3/4 of the states, a bar so high that conservative strategists were confident it would never be cleared. Let the progressives have their symbolic victory in Congress, the thinking went, and watch the amendment quietly die in the state legislatures. President Taft himself endorsed the plan, and on July 12, 1909, both houses of Congress passed the joint resolution that would become the 16th Amendment and sent it to the states, fully expecting it to fail. It didn't fail. It didn't come close to failing. State after state ratified it, faster and with less resistance than almost anyone in Washington had predicted, and on February 3, 1913, Delaware became the 36th state to approve it, clearing the constitutional threshold. The gambit designed to bury the income tax permanently had instead written it into the Constitution. It's one of the great unintended consequences in American political history, and it's almost never told that way. The 16th Amendment doesn't exist because the country demanded it in a wave of righteous reform. It exists because the people trying to stop it badly misjudged how tired the country actually was of a tax system that hit farmers and consumers while leaving fortunes untouched. Just months later, incoming President Woodrow Wilson made good on the opening. Working closely with Representative Oscar Underwood of Alabama and Congressman Cordell Hull of Tennessee, who personally wrote the income tax provisions and would go on decades later to serve as Franklin Roosevelt's Secretary of State, Wilson pushed through the Revenue Act of 1913, formerly known as the Underwood-Simmons Tariff Act. It cut average tariff rates from around 40% down to roughly 26%, the deepest tariff reduction since before the Civil War, and it paired that cut with a brand new, permanent federal income tax built on the freshly ratified amendment. Now look closely at what that tax actually was, because this is where the modern myth diverges hardest from the historical reality. People today tend to imagine the income tax as something that has always applied broadly to working Americans. In 1913, it applied to almost nobody. The law set an exemption of $3,000 for single filers and $4,000 for married couples, comfortably above what the vast majority of American workers earned in a year. Only around 2 to 3% of the population owed anything at all. For that small sliver, the base rate was a flat 1%. A graduated surtax kicked in above $20,000 in income and climbed, in careful, modest steps, up to a maximum of 6% on any income above $500,000, an amount worth well over $10 million today. Combine the base rate and the top surtax bracket, and you get the highest possible marginal rate under the entire law, 7%, not 70. 7. In its first year of operation, this tax generated less than a tenth of all federal revenue. It wasn't designed to fund the government. It was designed, quite explicitly, to make sure a small class of the very wealthy finally contributed something proportional to the burden that tariffs had been placing on everyone else for decades. It was, by any honest description, a boutique tax on the rich, not the mass institution we live under now. What changed everything was not a peacetime policy debate. It was war, the same force that had created the very first version of this tax back in 1861, arriving again to reshape it beyond recognition. When the United States entered the First World War in 1917, the federal government needed money on a scale the 1913 law was never built to raise. Congress responded with the War Revenue Act of 1917 and the Revenue Act of 1918, and the numbers moved almost violently. The top marginal rate, that modest 7% ceiling from 1913, had already crept up to 15% by 1916 as war clouds gathered in Europe. Under the new wartime legislation, it jumped to 67% in 1917, then to 77% in 1918, applied to income above $1 million. Even at that extraordinary rate, only about 5% of the American population paid any federal income tax at all, up from roughly 1% in 1913. But that narrow slice of taxpayers ended up funding close to a third of the entire cost of America's involvement in the First World War. The tax had transformed from a symbolic gesture into a genuine fiscal weapon, but it was still, fundamentally, a tax on the wealthy few, deployed at wartime rates that nobody in Washington imagined would become permanent. And for a while, they weren't. Once the war ended, Treasury Secretary Andrew Mellon, one of the wealthiest men in America and a fierce believer that lower rates on capital would spur investment and growth, led a sustained campaign throughout the 1920s to unwind the wartime rates. Through a series of revenue acts, the top marginal rate fell from that wartime peak of 77% all the way down to 25% by 1925. One of the fastest reversals of a major tax policy in American peacetime history. For most of the Roaring Twenties, the income tax receded back into something close to its pre-war character. Low rates, a narrow base, and a federal government still overwhelmingly reliant on other sources of revenue. Then came the Depression, and with it, the pendulum swung hard again. As federal revenue collapsed alongside the broader economy, the Revenue Act of 1932 pushed the top rate from 25% back up to 63% on incomes above $1 million, and the Revenue Act of 1935, sometimes remembered as Roosevelt's soak the rich tax, pushed it further still, to 79% on incomes above $5 million. Even so, through all of this, the income tax remained fundamentally what it had been since 1913. An instrument aimed almost entirely at a small, wealthy slice of the country. As late as the start of the 1940s, the overwhelming majority of American workers had never filed a federal income tax return in their lives, and had no expectation that they ever would. That is the version of the income tax that most people would recognize as historically distant, elite, occasional. What most people don't realize is that the tax system we actually live under today, the one that touches nearly every paycheck in America, wasn't built by any of the events described so far. It was built, almost entirely, in about 18 months during the middle of the Second World War, and it was built using tools that had almost nothing to do with tax policy and everything to do with psychology, marketing, and quiet administrative engineering. The turning point was the Revenue Act of 1942. To fund a war effort on a scale the country had never attempted, Congress didn't just raise rates on the wealthy again, though it did that too, pushing the top marginal rate to 82%, and eventually, by 1944, to a staggering 94% on income above $200,000. The truly seismic change was who the tax now applied to. The 1942 Act slashed exemptions so dramatically that roughly 15 million Americans who had never owed a dime of federal income tax in their lives suddenly found themselves liable for it. Layered on top was something called the victory tax, a flat 5% levy applied broadly across incomes, explicitly marketed as a patriotic wartime sacrifice rather than a permanent structural change. Almost overnight, the federal income tax stopped being a tax on the rich and became, for the first time in American history, a tax on the country. The government understood exactly how dangerous this shift was, politically. 39 million brand new taxpayers had no experience with the process, no cultural habit of setting money aside for the IRS, and crucially, no particular emotional buy-in to the idea that this was their patriotic duty rather than a raid on their household budget. So Treasury Secretary Henry Morgenthau Jr. did something almost nobody expects to hear in a story about tax policy. He commissioned Walt Disney. In January of 1942, Walt Disney Studios released a short animated film called The New Spirit, starring Donald Duck. In it, Donald listens to a radio broadcast urging citizens to pay their taxes promptly, works through his own tax return live on screen, discovers he owes $13 on an income of $2,501, and then, in a burst of patriotic fervor, races across the country by every available mode of transportation to personally deliver his payment to Washington, D.C., while the film cuts to imagery of American bombers and warships built. The narration insists. With exactly this kind of tax money, it was commissioned specifically to prepare 39 million first-time taxpayers for a filing deadline they had never faced before, dressed up as an act of wartime heroism rather than a legal obligation. The film was popular enough and effective enough that the Treasury commissioned a sequel the following year, The Spirit of 43, pushing the same message with even sharper urgency as rates climbed further. The Hollywood Academy took the first film seriously enough to nominate it for an Academy Award for Best Documentary Feature, an almost surreal footnote to what was, at its core, a government-funded advertising campaign designed to sell the American public on a tax increase. But the cartoon only solved half the problem. Persuading Americans that paying taxes was patriotic didn't solve the practical challenge of actually collecting money from tens of millions of workers who had never budgeted for a tax bill, and in many cases, wouldn't have the cash on hand to pay it in one lump sum the following spring. The solution to that problem is arguably the single most consequential and least discussed innovation in the entire history of American taxation: withholding. Under the current Tax Payment Act, signed into law in June of 1943, employers were required for the first time to withhold estimated income tax directly from every worker's paycheck and send it to the government automatically before the money ever reached the employee's hands. One of the Treasury officials who helped design this system was a young economist named Milton Friedman, who would go on to become one of the most influential free market economists of the 20th century, and later in life, one of the most vocal critics of government overreach in American economic life. Friedman later acknowledged, with a kind of rueful honesty, that he had been one of the architects of a system he came to regret building, because withholding didn't just make tax collection more efficient. It fundamentally changed how the tax felt. When money is withheld before you ever see it, you never experience the concrete, painful act of writing a check to the government for a large sum you've already spent months earning and often already spent. The tax becomes invisible, folded quietly into a paycheck that simply arrives smaller than it otherwise would have. The government's own Treasury Department has acknowledged, in its own official history of the tax system, that withholding greatly reduced the taxpayer's awareness of the amount of tax being collected, which in turn made it easier to raise taxes in the future. That is not a historian's interpretation. That is the federal government's own institutional memory of what it built and why. The results were immediate and permanent. The number of Americans filing federal income tax returns exploded from roughly 7 million in 1940 to 42 million by 1945, a six-fold increase in 5 years. Tax historians describe this transformation with a specific phrase: the shift from a class tax to a mass tax. Before the war, the income tax was something that happened to a narrow band of wealthy Americans, funded by 7% rates that most citizens would never personally encounter. After the war, it was something that happened to nearly every working household in the country, automatically, invisibly, every single pay period, for the rest of their working lives. Now bring these threads together, because none of them explain the modern income tax in isolation. You had a Civil War emergency tax that established the basic legal template and then quietly expired once its purpose passed. You had a Gilded Age populist backlash against a tariff system that punished consumers while sparing fortunes. A backlash so strong it forced income tax legislation back onto the table in 1894, only to be struck down by a Supreme Court that effectively closed the constitutional door on the idea entirely. You had a group of Senate conservatives who, trying to slam that door permanently shut, instead proposed the very constitutional amendment that reopened it, badly misjudging how quickly and enthusiastically the states would ratify what they assumed was a doomed proposal. You had a 1913 law that, contrary to how it's often remembered, was never intended to touch ordinary Americans at all, a boutique tax on a tiny fraction of the wealthiest households in the country. You had two world wars that repeatedly proved the federal government could push rates to extraordinary heights when national survival was at stake, and a 1920s tax-cutting campaign under Andrew Mellon that proved those wartime rates were never treated as permanent, at least not for the wealthy. And you had a specific 18-month window in the early 1940s when the government, faced with the need to fund the largest mobilization in American history, quietly rebuilt the entire architecture of the tax system twice over. Once culturally, by hearing the most trusted storyteller in the country to make an unprecedented tax hike feel like a patriotic duty, and once mechanically, by inventing a withholding system explicitly designed, by the admission of the man who helped build it, to make the tax as painless and invisible as possible. None of that is a story about inevitability. It's a story about specific choices made by specific people, at specific moments, often for reasons that had nothing to do with any grand vision of fairness or fiscal responsibility. Aldrich and the Senate conservatives who proposed the 16th Amendment weren't trying to build the tax system that exists today. They were trying to destroy the idea of an income tax forever, and they miscalculated so completely that they handed it constitutional permanence instead. Milton Friedman, one of history's most famous advocates for limiting government's reach into people's economic lives, helped design the single mechanism most responsible for making large-scale taxation politically sustainable in America. Walt Disney, in the middle of building an entertainment empire built on innocence and imagination, spent part of 1942 turning Donald Duck into a government spokesman for a war-driven tax increase aimed at millions of people paying income tax for the very first time. Every one of these people, as far as the historical record shows, believed they were doing something reasonable, even necessary, given the moment they were living through. Nobody sat down in 1909 or 1943 and said, out loud, let's build a permanent, largely invisible tax on the majority of the American workforce. It happened anyway, assembled piece by piece out of legal maneuvering, wartime necessity, cartoon propaganda, and a payroll mechanism most people have never thought about twice. That's really the part of this story worth sitting with. The modern income tax didn't arrive because the country had a long, deliberate conversation about what a fair, permanent tax system should look like, and then built one. It arrived because a doomed political trap backfired, because two world wars proved the government could ask for almost anything if the emergency felt real enough, and because the mechanism that finally made mass taxation stick was specifically engineered, by the government's own admission, to keep people from feeling how much they were paying. Every time you look at a paycheck and see a smaller number than what you actually earned, you're looking at a design choice made in 1943, not a law of nature. Every April, when tens of millions of Americans file a return expecting, and often celebrating, a refund, most of them are simply getting back money the government held, interest-free, for a year, a psychological arrangement that makes overpayment feel like a windfall instead of what it actually is. None of that is an accident. It's the residue of a system built, quite deliberately, to be as frictionless and as forgettable as possible. So the next time you hear someone talk about the income tax like it's an eternal, unquestionable feature of American life, it's worth remembering how recent, how contested, and how strange its actual path here really was. It was killed by the Supreme Court once. It was smuggled back into the Constitution by people trying to bury it forever. It applied to almost nobody for its first 3 decades of existence. And it only became the tax nearly all of us live under today because a cartoon duck and a quiet change to how paychecks get printed did more to normalize it than any act of Congress ever did on its own. If this changed how you look at that number on your pay stub, that's exactly the kind of story this channel keeps digging up, the version sitting underneath the one everybody already assumes they know. Subscribing means the next one lands in front of you without you having to go looking for it, so if that's useful, it's there. And I'm curious where you're watching this from, so drop a comment and let me know what city or state you're texting in from right now. I'll see you in the next one.